If you had to make a choice between purchasing a distressed commercial property or a stabilized one, which one would you choose? Would you choose the distressed property, 24 units, needs a roof, and very, very poorly managed? Or would you choose a more stabilized property that's 100% occupied and managed very well? Which one would you choose? Well, there's pros and cons to both, right? Now, on the distressed property, the pros would be you can buy at a discount because it's distressed, right? Number two, if you buy right, you can make a boatload of money. Number three, because the financing is not ideal to the lender, you may have to go the seller financing route or the creative financing methodologies that we teach. So there's seller financing potential, okay? The cons are it's risky. Buying distressed commercial property is risky. It's inherently risky, right? Many things can go wrong. And number two, the financing is not very straightforward. Right? Got it? All right. Now, on the other side, where we have a stabilized property, the pros are you're going to cash flow from day one. That's really important to you beginners out there. And number two, it's less risky, right? There's no heavy lifting. There is not a lot of rehab to do, which is risky, right? So this may be ideal for you. And number three, because the property has a stable financial history, great income and expenses that the banks can track and approve, you have the best bank finance possibilities. Got it? All right. The cons are you may have paid, right, market price or close to it. Now, for me personally, that may not be a bad thing, right? And we'll talk about that shortly. And lastly, you may not be able to raise the rates immediately. Again, I don't think that's a bad thing, but we'll talk about that in a minute. All right, so here's the next question. Which one do you choose? It's a personal preference, okay? So at what point do you choose the distressed property? At what point do you choose a stabilized property? It's all about you. Let's talk about that next. All right, here we are. Which one do you do? All right, distressed or stabilized? I'm going to address this question to you as a beginning commercial real estate investor. All right, so as a beginning commercial real estate investor, if you were to go after and pursue a distressed property, number one, do only light rehab, okay? No major rehabs, too risky, okay? Next, do not do 100% vacant properties. No matter how good the numbers are, don't do it. Too many things can go wrong with you as an investor. Contractor could rip you off. You could open up the walls and find disaster behind the walls. And those two things can take you down because you're a beginner, okay? Number three, you need to be well capitalized and have reserves. You need to have money to purchase the property, also to do the rehab. Do not consider doing the rehab with cash flow. Never happens, okay? So have all the money up front. Number four, exit strategy. It's so important and it needs to be conservative. So what is your exit strategy? Maybe you can buy, fix up, and sell, or buy, fix up, and hold long term, or buy, fix up, and do a cash out refi. Whatever you do, make sure your exit strategy is conservative, okay? Meaning you have room for mistakes. You have room for a changing market. You have room for when stuff doesn't go right, okay? All right. And number five, no DIYs, no do-it-yourselfs, okay? And the reason why is because if you're a beginner, too many things can go wrong here. So I suggest getting an experienced advisor, experienced coach, experienced team members on your team to help you do this side, okay? We can help you, all right? So a link will appear and how you can contact us. So do that if you're interested. Number five, I'm going to give you what I call a common sense formula for distressed commercial property, okay? This is pure common sense. If you don't follow this, I don't know what you're following. Okay, so watch this formula here. It's pretty simple. All right, so acquisition costs plus your rehab costs equals your all-in costs. Got it? Okay, so acquisition costs is your cost to purchase the building. Rehab costs, or your rehab costs, you add those two things and you get your all-in costs. Okay, you got it? So now you have your all-in costs calculated. Now, here's the formula. your ARV, your after repair value, must be greater, much greater than your all-in cost. Okay? Your ARV, your after repair value, must be greater, like greater than your all-in cost. Here's a quick example. Let's say your acquisition costs are $300,000. Just make it up. Your rehab cost is $100,000. So your all-in cost is $400,000, right? So your after repair value must be greater than your $400,000, all right? So you want your after repair value to be much greater than your $400,000, right? You want this number to be greater than $400,000 in order for it to make sense to you, okay? So don't have an all-in cost of $400,000, right? And have your after repair value $500,000. That's cutting it too close. Got it? Okay. Common sense formula. Whenever you look at any distressed property, make sure you do this, okay? If you don't, again, I don't know what you're looking at, okay? All right. Now let's go over to the stabilized side. On the stabilized side, if you're a beginner, these are just solid things to do in any market, okay? All right. Number one is to have reputable property management. So what is reputable property management? Well, you need to have a good reputation, good references, but really important, they need to have the 4 M's. Okay, we focus on the 4 M's in our company every single month. 4 M's. What are the 4 M's? If your property management company doesn't talk to you or send you reports on the 4 M's, do not hire them. Here are the 4 M's. Marketing, management, maintenance, and money. Okay? Marketing, maintenance, management, and money. You need to have systems for all 4 or you're in big trouble. Okay? Big trouble. So make sure your property management company talks to you and can talk about the 4 M's. Got it? Okay. Number 2, I want you to have, as a beginner, long-term financing. Okay? A lot of these commercial loans today, they'll do, 30-year amortization, but the loan ends in 5 years. It balloons in 5 years. I don't like those loans today, right? Because I think where the market is right now, you may run out of time and be caught in the 5th year in a down market. So I want you to have greater than 5 years, 7, 10, 12, whatever you can do, okay? All right, so greater than 5 years. Number 3, have a rainy day fund, okay? You need a rainy day fund for when stuff goes wrong. You may not want to call the insurance company, and stuff always goes wrong in commercials. It's part of being a good investor is to have a rainy day fund. And how much do you save up? And this is your initial savings account. You need to save 5% of your gross rental income. That's just the start, okay? So when you buy their property, the first 5% should go towards your savings. That's called a rainy day fund. It's the smartest thing you can do. All right. Number 4, I want you to do every quarter to do a market rent survey to see where the rents can go up. Yes, this is a stabilized property, but every once a year or twice a year, you should be able to bump up those rents. How do you know how much you can bump it up? You need to compare your property, right, and your amenities to another property and their amenities, okay? And that's called a market rent survey. Your property management company can do that, or you can do it yourself. Number 5, I want you to think long term. Long term in commercial is where the money is made. How many of you have heard of a person when they have inherited a property, it's been in the family for a long time and it's a lot of money, right? Well, it's because they had a long-term outlook. I want you to have the same thing, okay? Having a long-term outlook will set you up for your retirement, right? Having a long-term outlook will set you up to leave a legacy for your family. Having a long-term outlook will help you with ministry goals that you have, or charity goals that you have, or travel goals. It comes from thinking long-term in this business. Got it? All right. Number 6, I want you to focus on B and C class properties, right? Many of you think that the stabilized properties, the nice ones, are the A class. Not so. Don't focus on the A class because they're too expensive and return on investments are too low. Okay? Focus on the stabilized B and C class properties in good neighborhoods and think long term. Those 2 things are winners. All right? Okay. Now I want to share with you the secret to commercial real estate success if you are buying a distressed or stabilized property. Now, I have recorded a video with that secret or secrets. Okay, the link will appear. The video is called Secret to Commercial Real Estate Success. These are just absolutely bottom line things to know and to put yourself in a position to make the best decision on any commercial or income producing property. Okay, so make sure you watch that video. And the second link is if you are further interested in looking at distressed commercial property, I have a link here of a video, how to buy distressed commercial real estate. The link will appear, and go ahead and watch it. All right? Okay, everyone. Well, I hope you enjoyed this video on distressed versus stabilized commercial real estate. Whatever one you choose, I want you to be smart about it. All right? So thank you for watching again. And if you like this video, press the like, leave a comment, or I'll see you at the next video.